In the first two parts of this topic, we talked about a lot of accounting principles. In this last part, we want to remind ourselves what QuickBooks does for us that makes it such a powerful business tool, as well as define the two accounting methods, what they are, and how they compare to one another. Then you'll be appropriately primed for accounting using QuickBooks. Now, I like to keep things simple, and although accounting can be anything but simple, QuickBooks helps simplify it, if even just a little bit. There's something known as the accounting equation, which says, basically, our assets are equal to owner equity minus liabilities. If we had a company and the owner contributed $10,000 of their own money, and then we purchased $2,000 in inventory, we paid our office rent of $700, and then actually sold $1,200 worth of product, but only collected $500 of that $1,200. And if we actually used $250 worth of inventory that we had purchased, can you tell me quickly and easily what our current profit or assets or value of our company would be? Exactly. Now, you might be able to figure it out, but the point here is that we do not need to. By simply entering these few transactions into QuickBooks, QuickBooks will be able to apply things appropriately and create any variety of reports that not only tell us how we're doing overall, but also how we're doing in specific areas, such as expenses and income. That also includes things we still owe and monies that are still owed to us. Now, if that part of your brain that loves this kind of stuff is all a tingle right now, then great. You have the ability to look as in-depth as you want at all of the accounting that occurs behind the scenes, including delving into the general ledger itself. For those of us whose entire brain hurts even listening to me read what I just said, much less calculating anything from it, that is why we love QuickBooks as well. We can just write checks and enter bills and make sales and leave all that number crunching to the software, which is exactly what most of us want to do. One more thing, though, before we close out of our accounting primer, is to understand that there are two methods of accounting. By this, we're talking about when exactly we count money we made or money that we spent. The first method is known as the cash method. This is when income is credited only when money is actually received. In other words, when we get cash or a check or a deposit into our bank account from a customer. Expenses are counted only when a bill is actually paid. So it doesn't matter if we purchase a $3,000 computer system on a credit card using the cash system, it would only count when we actually paid off that credit card or made payments on it. There are a couple of rules, and again, you should consult your financial professional. But in general, any company that makes less than about $5 million per year can utilize the cash method or the second method. It's a choice. However, if inventory is resold to the public, then the IRS requires that you use something known as the accrual method instead of the cash method. The accrual method says that income is credited as soon as the transaction occurs, regardless of when we are actually paid by our customer. Likewise, expenses are counted as soon as the bill is incurred, regardless of when we actually pay the vendor for this expense. If you work in a business that is not something like retail, but maybe something more like construction, then income and expenses are entered when the job is complete, because a lot of times that takes a lot of time as opposed to somebody walking in and making a transaction at the moment. When it comes to things like tax time, there are pros and cons to both of these methods. For example, when it comes to paying taxes, you would probably prefer not to count any sales unless you actually received the money for it. But on the flip side, you would also like to claim you had expenses even if you haven't completely paid for them yet. This would minimize your tax liability. Unfortunately, you cannot mix and match. You must pick one accounting method and stick with it year to year. In order to change it, you would actually need to declare that you were changing it with the IRS, and then there's a whole process you need to go through. In general, the accrual system is a more accurate way to view financial status of a company, at least that's the opinion of most financial professionals. Why? Because it's very easy to feel good if you have $50,000 in the bank. But that's not really an accurate view of the company's viability if you have $50,000 in the bank, but you actually owe $100,000 in debt that you haven't paid for yet. By using the accrual method, it would accurately show that this debt existed, even though it had not been paid yet. With that, I think you've probably had enough accounting basics for the moment. When we started, I said that you don't need to know any of this, but hopefully knowing some of it helps you understand how QuickBooks works, why it asks for information the way it does, and why it's important to make sure that you set up your company file accurately and appropriately. I've said it before and I'll say it again. If you don't know how to do that, then please ask for assistance from a financial professional, because this is one time when accuracy really is critical, and making a best guess is not in your best interests. Try to keep these things in mind as you're working with QuickBooks, and you'll appreciate exactly how much work QuickBooks does for you so you don't have to think about it all the time. It will do the double entry bookkeeping, it'll work with the chart of accounts. All of that will be done on a day-to-day basis as you simply go through the simple tasks of working with simplified forms using the QuickBooks interface.